AGNC is one of the most popular monthly dividend stocks and the second largest internally managed residential mortgage real estate investment trust. The company was created in 2008, and until 2016 the company was registered under the name American Capital Agency Corp. The company generates income from the interest earned on their investment assets, net of associated borrowing and hedging costs, and net realized gains and losses on their investments and hedging activities. Since IPO, the company paid almost $45 in dividends per share. AGNC has a history of cutting dividends. Now the company pays 12 cents dividend every month, which is about 1% of the stock price. Monthly dividend stocks might seem to be interesting not only because they pay dividend every month, but also because reinvesting dividends every month is more effective than reinvesting dividends every year. But the difference isn't that big. Even after 12 years of reinvesting 1% dividend every month, a total return would be 390%, while 12 years of reinvesting 12% dividend every year would generate a total return of 289.6%. Usually the stocks that pay monthly dividends are real estate investment trusts. There are three types of real estate investment trusts: equity, mortgage, and hybrid. Equity real estate investment trust is a company that simply buys and manages real estate or develops it through collective investment. This type of companies generate income from both the growth in the value of real estate and from the rental of real estate. These investments are classified as conservative and considered a classic defensive asset. You can buy a house or an apartment too and rent it out, receiving passive income. But real estate is not as liquid as stocks, and not many people have enough money to buy a house to rent it out, which is why there is an alternative to invest in equity real estate investment trust. The main risk here is the decline of real estate prices. Equity real estate investment trusts tend to be cyclical and can be sensitive to recessions and periods of economic decline. Mortgage real estate investment trusts invest in mortgages, MBS, mortgage-backed securities, and related assets to generate revenue through interest income. Companies that are qualified as a real estate investment trust don't pay corporate taxes, but they need to meet a list of requirements to be qualified as a real estate investment trust. 90% or more of the income should be paid to shareholders in the form of dividends. 75% or more of a real estate investment trust's asset must be in real estate. 75% or more of its gross income must be derived from rents, mortgage interest, or gains from the sale of the property, and there are other requirements too. If a company is not qualified, it would be taxed as a domestic corporation. As a mortgage real estate investment trust, AGNC invests predominantly in agency MBS, mortgage-backed securities, financed primarily through repurchase agreements. The investment portfolio is worth $68.6 billion as of the end of March 2022. $47.4 billion agency MBS, $19.5 billion net to be announced mortgage position, and $1.7 billion credit risk transfer and non-agency securities. So what are these MBS and TBA? MBS are a type of bond that is made up of a bundle of home loans bought from the banks that issue them. Basically, MBS is a part of someone's home loan that bank resells to investors to free up capital. Since mortgages are long-term loans, it makes sense for banks to resell them to free up capital. It would be very ironic to pay your own mortgage with the dividends received from AGNC stocks, or even better, to buy AGNC stocks on the borrowed money from a bank and then pay your own mortgage. The cons of MBS are low liquidity and the chance of early repayment, which doesn't allow to accurately determine the duration and level of income. TBA, to be announced, the forward mortgage-backed security. This is used to indicate that the investor is acquiring some position of a pending pool of as yet unspecified mortgages, which will be specified at a given delivery date. Of course, MBS has a low yield as a low-risk bond, and the question is, how does AGNC manage to turn this low coupon into such a high dividend yield and also maintain it for years? So the point is that the company operates on a leveraged basis. The majority of AGNC's operations are financed via repurchase agreements. In a legal manner, the repurchase agreement is formalized as a purchase and sale, not as a loan, but it can conditionally be viewed as a short-term loan of funds secured by securities owned by the seller. Eventually, the company can increase or decrease the leverage on the portfolio, which will obviously have the impact of gains and losses. So basically, there are three key factors that have the impact of gains and losses: the leverage, the repo rate, and the mortgage rate. The higher the mortgage rate and the lower the repo rate, the higher the profitability. Since March, the FED increased the key rate, this will have negative impact on the company's profitability. Borrowing costs increase as the repo rate jumps up, while the fixed rate mortgages stay the same. AGNC has already started to play defensive and deleverage the business. As CEO said, "We started the quarter with a defensive position characterized by lower leverage and a high hedge ratio. We also took meaningful steps during the quarter to further reduce our aggregate risk profile. These steps included reducing our asset position, adjusting our coupon profile, and increasing our hedge portfolio. As the FED aggressively raises short-term rates and ramps up its balance sheet runoff, we will likely remain defensive in our portfolio positioning." So I assume that there is a pretty high chance that the company will cut dividends again. That's all for today, and thank you for listening.